Fastly reported third quarter fiscal year 2024 financial results on November 6, 2024 that disappointed stock market investors. The stock price is down considerably year to date in 2024, and investors were hoping for better results from the company. Now, I'll review the company's latest financial results, the big picture items that investors need to know, and also I'll update my recommendation for Fastly stock. Remember, I did not have the stock rated as a buy. I told investors that I thought the stock was a hold because of the company's limited progress on the bottom line, limited growth on the top line, and an expensive valuation. You're going to want to tune in to see if I'm changing that recommendation. I will update and let you know if I think it's a buy, hold, or a sell. So let's get into the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Fastly reported total revenue of $137 million, representing just 7% growth year over year. For the 9 months ended September 30th, the company reported $403 million in revenue, up from $368 million in the same time last year. They are making progress on the bottom line. GAAP operating losses of $40 million in the most recent quarter ended September 30th was an improvement of the $58 million in losses on the bottom line in the same quarter last year. So that's a roughly 1/3 improvement in operating losses. That's what you like to see with companies like this. I don't mind companies that are losing money on the bottom line when they're in growth mode, when they're investing in growth options, but I don't like when they're not making some progress on the bottom line. Fastly is definitely making progress on the bottom line. One of the key things investors must pay attention to with Fastly is the enterprise customer count, which in the most recent quarter was at 576, and that was down 25 from the second quarter of 2024. The industry grew during that time, so Fastly is losing market share, losing customers to competitors, while the total customer count was 3,638 in the third quarter, and that was up by 343 from the second quarter of 2024. Thankfully, they are growing in that segment. Another critical metric to consider with a company like Fastly is the net revenue retention rate, or as they call it, NRR, LTM NRR. In the last 12 months, the customers that were with the company for more than 12 months, or in other words, repeat customers, are they increasing or decreasing spending with Fastly? And with them, they're increasing, but that rate is falling. So in the most recent trailing 12-month period, the net revenue retention rate fell to 105% in the third quarter, and that was down from 110% in the second quarter of 2024. That means customers this year are spending 5% more with Fastly than they did in the previous year. In the second quarter, that was 10% more. So they are experiencing some customer decrease, some customer exodus, losing some market share. And these are statistics you don't like to see from a company in this industry, the cybersecurity industry, the API performance improvements, helping digital media companies perform better, the websites. This is an industry that's growing by more than double digits. So for Fastly to not be growing by double digits means it's falling behind the industry growth rate, which you don't like to see in an investment, especially when an investment is trading at a premium valuation like Fastly is. The remaining performance obligations increased by 6% to $235 million. That was a mediocre result. 6% increase in remaining performance obligations and revenue growth of 7% means the company's RPO is growing at a slower rate than revenue, which is not growing at an explosive rate either. This $235 million will eventually turn into revenue as the company performs these obligations. But if you compare the RPO with the company's revenue, they have less than 2 quarters worth of RPO. So in other words, they have $235 million in performance obligations remaining, and their revenue in the most recent quarter was $137 million. So they don't have this huge backlog of contracts like some of these other cybersecurity companies do. That's another downside with Fastly. Looking ahead, management is forecasting revenue of $138 million at the midpoint, with non-GAAP operating loss of $3 million at the midpoint. If you compare that with the previous quarter, they just reported $137 million in revenue. So in the fourth quarter, they're expecting very minor increase in revenue from 137 to 138 million. That's more of a rounding error rather than significant sequential growth for the company. In terms of the bottom line loss, they're expecting a $3 million non-GAAP operating loss in the fourth quarter, and that would actually be worse than the $520,000 in operating loss they reported in the quarter that just ended in September 30th, $520,000. So not very much improvement here expected from management in the next quarter, and the just released quarter wasn't all that explosive either. Fastly stock is now trading at $7.34 per share and has been flat since July of this year. But earlier in the year, it was trading at over $24 per share. So after falling and losing significant valuation to start 2024, the company has traded flat in the second half of the year. It's now trading at a forward price to sales ratio of 1.8, which, if you were to ask me if this valuation makes the stock a buy, hold, or a sell, I'm going to lean towards saying the stock is not a buy. So as I highlighted earlier, I've not had the stock rated as a buy. I had it rated as a hold, and I last updated that recommendation on May 2nd for similar reasons why I updated and showed and shared with you in this video here. So to update this recommendation here today on November 13th, I will reiterate that I still think the stock is just a hold. I don't think the performance justifies the valuation if the company can re-accelerate revenue growth or re-accelerate the remaining performance obligations, which would indicate an improvement in customer demand for its products and services. I would be more interested in recommending Fastly stock. As it is, you can see here on my list, I have several other companies that I would rather have ranked higher than Fastly according to its current valuations and its prospects over the next several years. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.